Welcome friends. We have discussed how to calculate the free cash flow for Cisco HomeNet project and we have seen that it is giving a very good positive NPV of 2.862 million if it accepts the HomeNet product and this project is giving very profitable one. The IRR is somewhere around 26.67%, which is far better than the required rate of return, which is 12%. And we have seen how incremental earning is calculated, how the depreciation is added back, initial investment is deducted, and working capital impact is adjusted so that we get the free cash flow. Now we have uh, up to now normal cash flow calculation and the capital budgeting technique. Some other techniques also can be applied, like modified internal rate of return, like payback period, discounted payback period, profitability index. All these things can be applied for this judging the project, whether to take or not, evaluate the project. Now we will use certain kind of risk factors we will consider for taking the project, like opportunity cost, project externalities, sunk cost, and we will adjust the free cash flow. Opportunity cost is, if you would not have taken this new product, the money could be used somewhere else. So that is the opportunity cost. So you have to consider that. For example, the new business is going to be operated from the owner's own building. If it is not being done, that building could have been rented out. That building could have been used for some other purpose. So the cost will be taken here as opportunity cost. Though it is the building belongs to the owner, still the no rent is to be paid, still rent is to be calculated under the opportunity cost. Project externalities. Normally, this is known as the word called cannibalization. Cannibalization is a word used for eating the same species. For example, a particular animal eats the same animal, then it becomes cannibalization. So, same cannibalization applies in business also. How a company here introduces a new product means its existing product sale, if getting reduced, then the new product is eating the market share of the existing product. For example, Apple's iPhone. You see, Apple makes the upgradation time to time. Starts from Apple generation 1 to Apple generation 12. You can see every fixed interval of time a new product is being launched in the market. So if the new product is launched, for example, after iPhone 12 is launched, definitely the sale of previous products like Apple 6, 7, 8, iPhone X, all these sales gets affected because of the launch of the new product. So new product sales might have been increased, but the existing product sale might have been reduced. So the new product is eating the sale of the existing product. It's cannibalization. That also you have to consider when you are introducing a new product. Sunk cost. The fixed overhead expenses, past research and development. For developing a new product, a lot of research and development takes place. For example, the vaccine came for COVID-19. You see the vaccine, whether it is AstraZeneca company has developed or Pfizer has developed, both have uh, both have spent billions of dollars for development of the particular vaccine under the head research and development. So the research and development cost, once the product is developed, the product sale price if you take, you have to also consider the past research and development expenses spent to get this particular vaccine. So that is also to be taken into account while considering the product sale and the capital budgeting decision, the research and development expenses to be treated, where we will see unavoidable competitive effects. If you are, once time passes, new competition will come in the market. So you have to also consider the competition in the market. Adjusting the free cash flow for all these things like time of cash flows and depreciation. Normally in US, one of your friend asked me a question about depreciation previous class. I said in the capital budgeting we'll discuss this. That is MACRS. MACRS is modified accelerated cost recovery system. This is a method of depreciation approved by the GAP and Federal Reserve and the US tax authority for kind of charging depreciation. The rate of depreciation is given in the last slide of this particular chapter. We will see that. An example, what depreciation deduction would be allowed for HomeNet 7.5 million lab equipment using MACRS? See, we have calculated the depreciation in the previous calculation using straight line method. How we have done? 7.5 million is the testing equipment divided by life of the equipment 5 years. So 1.5 million we charged depreciation. But what will be the change if the company uses MACRS? Go to the last slide please for MACRS. Here is the MACRS, you see. As per the MACRS, the depreciation of an asset can be allowed to be charged either 3 years, 5 years, 7 years, 10 years, 15 years and 20 years. Normally, land, building, all these things will be charged on the long-term basis, like 20-year kind of thing. Software equipment can be charged on the basis of 3 year, and normally equipments, machineries, etc. normally 5-year MACRS will be allowed. Every 3 years means it is to be spreaded in 4 years. So 3 means 3 plus 1. 5 means 5 plus 1. 7 means 7 plus 1. 10 means 10 plus 1, like that, 1 year extra. So the schedule is given here. 15 means 15 plus 1, like that. Here for HomeNet, we are talking about 5 years MACRS. Then depreciation will be charged on the year 1, 20%, year 2, 32%. See the 5 year schedule. Year 3, 19.2%, year 4 and year 5, 11.52%, and year 6, 5.76%. So if that is happening, let us go and see the depreciation there. Yes. So the depreciation will be lab equipment is equal to 7.5 million. You have seen MACRS 5 years schedule. 5 means 0 plus 5. Why it is always 5 years means 5 plus 1, 3 means 3 plus 1? Because 0 year also the depreciation is charged, the year when it is purchased. So 5 means 5 plus 1, 0 to 5 years. 3 means 0 to 3 years, like that. Here we will charge 5 years MACRS, that is equal to 0 to 5 years. The depreciation is spreaded at the rate of 20, 32%, 19.2%, 11.52, 11.52 and 5.76. Very simple. Calculate the depreciation now. 20% of 7.5 million is equal to 1.5 million. 32% of 7.5 million is equal to 2.4 million. 19.2% of 7.5 is equal to 1.44. 11.52 of 7.5 is 864,000. 5.76% of 7.5 million is equal to 432,000. You have seen one very speciality of MACRS. The depreciation, the highest charged in the year 1. Why? Because year 0 and year 1 you charge the maximum depreciation. Why? After that, the machine becomes older and the machine will need repair and maintenance. So if you charge depreciation, you charge repair maintenance, unnecessarily the income statement will be overburdened. The profitability will be reduced. That's why year 0, the machine is very new, charge maximum like 20%. Year 1, the machine is completely geared now, it is completely ready to work, its maximum efficiency will come, repair maintenance will be the minimum, so charge the highest 32% depreciation. Same in 0, in 3 years MACRS, 5 years MACRS, 7-year MACRS, 9, all these MACRS, the depreciation charged high in the in the initial years, and depreciation will be very low at the later years. Then we will calculate now. The depreciation is 7.5 million, and accordingly the if depreciation would have been calculated on MACRS, what would be the result? Instead of previously we calculated depreciation on straight line method, and our NPV would be our NPV was how much? 2.86 million by charging the depreciation at fixed straight line method. For example, depreciation would have been calculated on MACRS. The depreciation amount would be 1.5, 2.4 like that, and the NPV would be more than the previous situation, 2.913 million. Previously, how much with straight line method? NPV were 2.86 million. But if you charge MACRS, then NPV would be 2.913 million because of depreciation tax sales are delayed by 1 year relative to the case where equipment is put in use before year 1. So next calculation is how to adjust the profit on or capital gain and how to pay the tax on the capital gain. Whenever a machine is sold, definitely there will be either capital gain or capital loss. If there is a capital gain, how the tax is adjusted? That will be the next level of discussion we will make. For calculating the capital gain, the formula is very simple. Sale price minus book value is equal to capital gain. Always you know, capital gain means if your selling price is more than the book value of the asset, you book a capital gain. If the sale price is less than the book value, there is a capital loss. Now, how to calculate the book value? Book value is equal to purchase price minus accumulated depreciation. So after tax cash flow from asset sale will be equal to sale price minus tax rate multiplied by capital gain. How? Let us take this exercise. As a production manager, you are overseeing the shutdown of production line for a discontinued product. You are seeing one product line already discontinued, so no need of this product line. You are interested to selling it, dispose. So you are planning to sell it. You got an offer for 50,000. So if you sell it, you will get 50,000. The equipment was originally purchased and put into use 5 years ago for 500,000. Today you are planning to sell for 50,000, which is purchased 5 years before at 500,000. Depreciation is used on MACRS basis. MACRS 5-year schedule you are using. If your marginal tax rate is 35%, what is the after tax cash flow you can expect from selling the equipment? Your plan is use the MACRS schedule to determine the accumulated depreciation. Number 1, because this asset is purchased 5 years before for 500,000. We will use the MACRS. We will calculate the book value till now. Determine the book value using the MACRS. Determine the capital gain. The book value and the selling price you compare. If the selling price is better than the book value, there will be a capital gain. Then calculate the tax on the capital gain. Let us do it. The asset is purchased for how much? 500,000. So MACRS is for 5 years. 5 years MACRS says how what? Year 1 20%, year 2 32%, 3 19.2, year 4 11.52, year 5 11.52. So 500,000 20% is 100, like that calculated 160, 96, 57, 600, 57, 600. Total depreciated value till now, year 1, year 2, year 3, year 4. Total depreciated value is 471,000. Right? So 5 year finished, all depreciation are charged. So the book value remained is 500,000 was the purchase price. Already depreciation charged 471, 200. That means the book value remains 28,800. This can also be calculated using the last year's depreciation, 5.76 in the MACRS, 6 years. 6 depreciation percentage is 5.76. So 5.76% of 500,000 is equal to 28,800. Either this way or that way you can calculate book value. So the remaining book value of the asset is 28,800. Why? You purchase at 500,000. You have charged the depreciation up to now 471 200. Therefore, remaining book value is 28,800. But what is the capital gain then? You sold for 50. The book value is 28,800. So the capital gain is 50,000 minus 28,800, 21,200. Tax owed on 21,200 is 35%, 7,420. Now the after tax cash flow from this sale is you are selling for 50,000. Tax is 7,420. So after tax cash flow from this sale is 42,580. I hope it is clear to all of you. So we have to make the, let me